Welcome back to Let's Invest with the ASX. In this video, we will cover the basics of technical analysis, which is a valuable skill for making investment decisions. Technical analysis is a method of evaluating financial markets by analyzing historical price data and patterns to predict future price movements. Technical analysis relies on charts, patterns, and historical price data to identify trends and make predictions. Technical analysts believe that all relevant information is reflected in a stock's price and trading patterns. Critics argue that technical analysis overlooks fundamental factors and may lead to erroneous conclusions. There is an ongoing debate between proponents of fundamental and technical analysis. Some investors use a combination of both methods. Technical analysis allows us to analyze charts and make observations about share price movements without knowledge of specific company information. By examining a chart, we can identify peaks and trends in the share price, indicating whether it is in an upward or downward movement. Technical analysts believe that charts reflect all available information, so we don't need to rely heavily on news releases or fundamental factors. If someone possesses unique information and acts upon it, it can influence the price and cause it to shift to a new level. Charts provide a visual representation of historical price patterns and help predict future price movements based on these patterns. Charts cannot predict the future, neither can fundamental analysis. Simple charting techniques can provide insight into market sentiment. Technical analysis can be divided into three categories: classic technical analysis, indicators, and cycles in price and time, such as Gann or Elliott wave theory. Classic technical analysis and indicators will be discussed in this chapter. Price and time cycles are not covered in this book. The technique will be built using three tools: trends, resistance and support lines, and chart patterns. Trends. Different types of charts are used to analyze price action, including line charts, point and figure charts, market profiles, and candlesticks. The most common type of chart used is the bar chart. Bar charts represent price data with vertical bars, where the left tab represents the open and the right tab represents the close. By plotting consecutive days on a chart, analysts can observe the interplay between supply and demand. Bar charts can be used to create different time frames, such as daily, weekly, monthly, or even 1-minute charts. The first step in technical analysis is to identify the trend, which indicates a period when the price is moving more in one direction than the other. An uptrend refers to a period in which the share price is consistently rising. It is considered a favorable environment for owning shares, as it allows for capital gains from rising prices. Identifying and isolating upward trends is of particular interest for investors seeking to profit from price appreciation. An uptrend is a sustained and consistent increase in the price of a security or market over a period. It is characterized by higher highs and higher lows, indicating a positive trend in which buyers dominate and prices generally rise. Downtrend. Downtrend. A market trend characterized by a series of lower lows and lower highs. Each high point in a downtrend is lower than the previous high, and each low point is lower than the previous low. Purchasing shares in a downtrend is generally considered unfavorable by technical analysts. It is advisable to wait for an uptrend to emerge before considering buying shares. Markets, however, are not as simple as the diagrams, and there are periods when the market is in neither an uptrend nor a downtrend. Sideways trending. Sideways trending refers to a market condition where the price of an asset moves within a narrow price range. It is also known as a horizontal or range-bound market. In a sideways trend, the highs and lows of the price remain contained within a horizontal channel. It indicates a period of consolidation or indecision in the market. Supply and demand are relatively balanced during a sideways trend. It lacks a clear upward or downward momentum, making it challenging to identify a prevailing trend direction. Change of trend. After defining uptrends, downtrends, and range trading, the next step is to utilize them in the marketplace. The goal is to exit downtrends early and enter uptrends once they are confirmed. Understanding these trends makes it easier to identify and locate them in the market. Determining the market or share's direction, uptrend, downtrend, or sideways trend, simplifies the process of identifying the best opportunities. It saves time by providing an objective assessment and requiring minimal interpretation. Instead of spending hours analyzing charts, defining the trend should take less than 5 minutes and can be done quickly with a glance. Resistance and support lines. While there are some limitations with classic technical analysis, it can provide some assistance in fine-tuning the timing of a change in trend. A resistance line represents a price level where upward price movement halts and transitions to sideways or downward movement. It is created by connecting the highs of price movements over a period. The resistance line indicates an abundance of supply in the market, where sellers enter to sell shares when the price reaches that level. The cumulative selling pressure at the resistance level prevents the price from further increasing. Traders and investors pay attention to the resistance line, as it can act as a barrier for further upward movement and may provide opportunities for selling or shorting positions. When the price breaks through a resistance line, it indicates that the selling pressure at that level has diminished or ceased temporarily. This breakthrough can suggest that sales at the resistance price are completed or that sellers have decided to hold off or change their minds about selling. Breaking through the resistance level can be seen as a positive sign for the share or market. It may reflect the release of good news or a positive market sentiment that has influenced sellers to hold off. Technical analysts view a break of resistance as a buy signal, indicating a potential opportunity for traders to enter long positions or increase their bullish stance on the share. However, it's important to note that other factors and analysis should be considered to confirm the significance of the breakout and assess the overall market conditions before making trading decisions. Support line. A support line is a level where declining prices stop falling and move sideways or upwards due to sufficient demand. It is created by connecting the lows of price movements. Breaking through the support indicates a lack of buyers at that price level and increasing selling pressure at lower prices. Technical analysts see a break of support as a bearish signal, suggesting a potential downward trend and more aggressive sellers. Traders may consider selling or shorting positions based on the break of support, but additional analysis is advised. Volume. Volume is an important tool for technical analysts in analyzing market trends. Rising volume during a break of support or resistance is considered confirmation that the break is legitimate and indicates the price is likely to continue moving in the same direction. Increased volume can suggest the participation of more sophisticated investors or a growing interest in the investment or trade. Technical analysts prioritize what the chart is indicating rather than the specific reasons behind the volume increase. The use of volume in conjunction with breaks of support or resistance can provide additional insights and confirmation for traders. Rising triangle pattern. In the depicted figure, the resistance line is horizontal. Technical analysts observe that when the resistance level remains flat, there is sufficient selling to match the buying at the same price. However, the upward sloping support level indicates that buyers are becoming more aggressive and willing to pay higher prices. The reason behind this increased buyer aggression is not of concern to technical analysts. If the price breaks through the resistance level, it suggests that buyers are even more aggressive, while the selling diminishes. Technical analysts predict that prices should rise in such a scenario. Rising volume further confirms the market's strength. It is important to note that no strategy works perfectly all the time. Traders typically buy shares as they break through resistance, but there is always uncertainty about the future outcome. Traders may experience multiple instances of buying shares only to see the price drop back down before getting it right. The advice of "let your profits run and cut your losses" emphasizes the importance of taking small losses quickly rather than allowing them to grow. Successful traders may have many losing trades, but their ability to recover quickly from those losses contributes to their overall success. The next step. It is crucial to establish an objective process before investing your money. Define shares in uptrends and disregard those that are not. Apply a filter to confirm the trend and establish an additional prerequisite. Once the trend and requirements are met, utilize entry and exit methods for purchasing or selling the share. Adding a filter. Filters or indicators are conditions that allow or disallow certain actions. Avoid the mistake of using too many indicators or trying to combine them all. Using one indicator consistently can be as effective as using multiple indicators. No indicator works perfectly all the time. Avoid spending excessive time searching for a flawless indicator that guarantees no losses, as such an indicator does not exist. Choose one indicator that you understand and can use effectively. Follow these steps for selecting an appropriate indicator. 1. Find an indicator that you comprehend. 2. Learn how to use it properly and consistently. 3. Keep your losses small when you have losing trades. 4. Allow your winning trades to run and maximize their potential. 5. Expect to have more losing trades than winning trades. Over time, if your winning trades are consistently larger than your losing trades, you should be profitable. Using indicators. Explore a simple indicator and its trading possibilities. Add a trigger to the indicator to refine timing and achieve specific day-based entry or exit points. The goal is to improve the efficiency and effectiveness of the filter or indicator. The moving average. The moving average is a commonly used tool by investors and traders. It calculates the average of closing prices over a specific number of periods. N represents the number of periods in the moving average. A 30-day moving average calculates the average of the last 30 days' closing prices, updated daily. Similarly, a 3-day moving average calculates the average of the last 3 days' closing prices, updated daily. Decide the time period for N days, weeks, or months. Larger N values provide smoother averages with fewer trades and false signals. However, they may result in missed opportunities. Shorter-term moving averages allow earlier entries and closer exits. But they generate more trades and false signals, leading to more losses. Experiment with different periods, example, 15 days for short-term traders, 30 weeks for long-term investors, to find what works best for you. The common way to trade the moving average is to buy a share if its price breaks above its moving average, and to sell it again when the price falls below the moving average. Applying the moving average. Before relying solely on the moving average indicator, keep in mind the following points. No indicator works perfectly all the time. The moving average can be effective in identifying and staying in uptrends and signaling exits during downtrends. When the price falls below the moving average, there is a risk of a downtrend, and traders may choose to stay on the sidelines to avoid further losses. The moving average is not suitable for non-trending markets, as it leads to buying high and selling low, resulting in losses. A trending market with higher highs and higher lows is ideal for using the moving average. In a ranging market, oscillators are more appropriate than trend-following indicators. Combining tools. When presented with two companies with favorable fundamental characteristics in a growing sector. Low debt to equity. High dividend yield. Strong return on equity. Strong historical dividend growth. Assess the technical analysis aspect by considering the position of their share prices relative to the moving average. If Company A's shares are above the moving average and Company B's shares are below a declining moving average, it suggests a more positive market consensus for Company A. This difference in market sentiment could be due to undisclosed market information or better market sentiment surrounding Company A's shares. Combining fundamental and technical analysis provides a more comprehensive understanding than relying solely on fundamental analysis. Triggers. Adding a trigger to the technical analysis process can enhance the effectiveness of the moving average as a trading tool. A trigger is a formation or price level that must be met before entering a trade. One commonly used trigger is the channel breakout method, where the trader looks for a breakout above a previous period's highest high. To implement this method, identify shares that have broken above their 30-day moving average. Confirm the trade by observing if the price rises above the high of the day that broke above the moving average within the next 2 days. This trigger acts as an additional filter to confirm the upward momentum in the market. By requiring the price to break above the moving average and exceed the high of the breakout day, this approach aims to avoid false signals and improve trading decisions. Using the trigger can help avoid entering trades that may result in losses. It reduces the number of overall trades, lowers brokerage costs, and minimizes losses in the trading account. Thanks for watching. Don't forget to like, subscribe and use the flashcards.